Hello. So we'll be now starting with the problems. So looking at the problems, we have to work out the formulas. Okay. So formulas we'll first see, then we'll move on to the problems here. So we'll first start with what is the variances here, and then we'll move on to the actual variances. So sales variance is the only positive variance in all these in all standard costing. So we can put it as income variance. So how do we calculate variance? So variances are calculated in this manner. There are any variance can be split into two types. Okay, so one which measures the price, rate, or the cost of it. Okay, the cost of that item, and the second one measures the volume of it. Okay, so there are two ratios here. The first one tells you how the variance, okay, the difference between the standard and actual sales, okay, is differing because of price and because of volume. So there are like actually two variances here. So the first variance, price variance, sales price variance formula is this AQ. So we have it here, AQ into SP minus AP. So that is the formula here. So what is AQ? See, throughout this chapter, A refers to actual, Q refers to quantity, and S refers to standard, and P refers to price. Okay, so once you have that idea, it becomes like quite easy. So I think it's shown here. So you got it here. Okay, and the volume ratio is like SM into SQ into minus AQ. So what is SM here? Okay, so SM refers to standard margin. Okay, M refers to standard margin. Okay, margin, there are like two problems here. One is like we can solve the entire variances or standard costing using marginal approach or absorption approach. If we are going to solve the problem with marginal costing approach, then the SM here refers to standard contribution per unit. Okay, standard contribution per unit, which is equal to the selling price, the standard selling price per unit. Okay, minus standard variable cost per unit. Okay, see, what we want here is a standard. So SM is refers to standard. If we are going to work out marginal costing, then it's going to be, see, all these numbers are standard numbers only. Okay, it's not about actual numbers, it's all standard. So contribution per unit minus selling price, contribution per unit equals to selling price per unit minus variable cost per unit. If the question is going to tell you that the variance is absorption costing based, then what we have to find out is the SM then becomes a uh, profit per unit. Okay, it becomes profit per unit, which is equal to selling price per unit minus variable cost plus fixed cost. Okay, both you have to take into account and then minus that. So that's about the sales variance here. So always be very thorough. A refers to actual, P refers to the price, Q refers to the quantity, and in this one, M refers to the margin. Okay, so only in sales variance we have this two kinds of bifurcation for margin and absorption. In other variances, it doesn't work like that. Okay, so and all variances can be, the answer of all variances can be like split into two, whether it can be a positive variance or a favorable variance or a adverse variance. But we'll see those variances and all, whether it's favorable or adverse, we'll see it in a problem. We don't need to confuse a lot of things here itself. So let's look at the second variance here. These variances, from here on, it's called as cost variances. Okay, we'll just add a two line, and it's called as cost variance. So this is the formula. Usually, okay, this is the formula here. See, cost refers to the total cost. Okay, the material cost variance. Okay, it can be like split into two things here. One is price and usage. Okay, cost is something like total. If you add both these, you will get this as the total. Okay, so we can even put it like this: the cost variance here will equal to the price variance plus usage variance. Okay, so this is equal to price plus usage. Okay, price plus usage. So these two variants are more important. Okay, but this is also in some questions they ask you this part. So let's see. Cost variance is like very simple. It is equals to standard price into standard quantity minus actual price into actual quantity. That's it. What is price variance? See, price variance is not something new. You can take the same sales price variance. No, here what you had, the same formula only will repeat here. Okay, so what's the formula here? Again, AQ into SP minus AP. For usage, we have something called as a usage, right? In usage, the variance is standard price into standard quantity minus actual quantity. That means this ratio which you saw here, the volume ratio, it's similar to the usage ratio. Okay, so SP into SQ minus AQ. So that's about the formula here. So add both these, you will get the cost variance. Okay, so that's about material here. And okay, we are not going to look at closing stock. Okay, we are not going to look at closing stock, but we will be looking at the labor. So how do we compute labor? See, labor again is split into two main ratios here. Okay, so there's one ratio called as total. So total is nothing but rate plus efficiency okay, rate plus efficiency. So you add these two together, the answer of all these will be this. Okay, so again, see, this is not a new ratio here. We have the wordings like SR. SR is standard rate. Okay, R here refers to rate. Okay, so R here refers to the rate, and the H here refers to hours. Okay, and S refers to standard. Okay, so this ratio is also not a new ratio. What you can do is you can substitute the Q. Okay, so here, sorry, R can be substituted by P. For example, if you look here, in material variance it is standard price, here it is standard rate. In material it is standard quantity, here it is standard hours. Okay, minus here it is actual price, here it is actual rate, and again here it is actual hours. In material it is actual quantity. Okay, so you get the idea here. Just substitute the price becomes rate and quantity becomes hours, then you will get the same variance. It's nothing new or different. What is rate variance? So it is actual hours into standard hours minus actual rate. Efficiency is standard rate into standard hours minus actual hours. So this also you'll get the answer here. Okay, so sometimes you might get idle variance. So when we get idle variance, we'll look at that. Okay, now we don't need to worry about idle variance. We are looking only at the basic variances. So if you see, the next one is variable overhead variance, right? Variable overhead variance. So if you look at variable overhead variance, it would be as same as labor variance. So I'll take the labor variance. I will just paste it next to the variable overhead variance. Okay. So I'll paste it, you'll get an idea. Look at here. You will find out that the variable overhead variance is like same to labor variance. See, total. Okay. Here the variance called as expenditure. In variable overhead, what is called as expenditure? In labor, it is called as rate. But the formula is same. See, AH, SR, and minus AR. Okay. Efficiency. Here, what we call as efficiency. In labor, we call it as also efficiency. So it's like similar. So look at the rate for it. Sorry, the formula for it. SR into SH minus AH. SR into SH minus AH. Okay. So the labor variance and the variable overhead variance are like very similar, except for the name. Their name alone might change. Okay. So that's what the concept here is. And the last and the most trickiest one is the fixed overhead variance. Okay. So what do we do with fixed overhead variance? That is the most trickiest part. So in fixed overhead variance, we have like many types of variances. So we have cost variance, expenditure, volume, capacity, efficiency. There's also calendar, but in RSum we won't be using calendar, or else we can even remove it. So in total you have only like five formulas. So each formula has a breakup. Okay, each formula has a breakup. Okay, so the first one is called as cost is equal to R minus A, expenditure is equal to B minus A, volume is R minus B, capacity is S minus B, efficiency is R minus S. Okay, now what is this R, A, S, B and all? So we have a separate explanation for that. B is budget, A is actual, R is recovered, and S is standard. So first you have to work out this formula, this set of formulas. Then only you can apply it here. Then only you will get the answer here. Okay, so it is a lengthier one. So how do we find out what is a budgeted number? Okay, see, budgeted number is very simple. Multiply budgeted units into standard rate per unit. You will get the answer. Actual is actual units into actual rate per unit. Recovered is, so you can see here, recovered is take the budgeted overhead divided by budget units into actual units. If you put that, you will get recovered. Standard is budgeted overhead divided by budgeted hours into actual hours. If you put, you will get the standard. And the most important part is this proofs. Okay, what is this proof? You don't need to work out this proof. It's only for you to understand. See, this cost variance, okay, is equal to expenditure plus volume. Okay, so the answer of these expenditure and volume, if you add, you'll get the cost variance. Then what is volume? Volume can be divided into two, which is called as capacity and efficiency. Okay, capacity and efficiency. So add these two, you will get volume variance. Okay, so that's about the concept here, right? That's about the concept here. So we have gone through all the variances. First we'll work out this. Then what we will do, we'll apply this to we'll apply these things to the to a problem. Let's first solve a problem. Okay, then thereafter we'll see what is the implication of these ratios. Okay.